Hi friends, now in this session we'll discuss measures of leverage from CFA Level 1's corporate issuer. This reading is useful for 2023 curriculum but not useful for 2024 curriculum. So you have to make sure if you are going for 2024, don't prepare this reading. You don't have this reading in your curriculum anymore. But till 2023, that is on November 2023, this reading is useful for you. So make sure you understand this reading properly. Now in this reading, we have three components. So three broad areas. First is related to the BEP, break-even point. The second relates to the degree of leverage, that is a degree of operating leverage, financial leverage, and the total leverage. And then we have impact of DFL, degree of financial leverage, on return on equity. So these are the three broad points. Now to understand this particular reading or these concepts, BEP, DOL, DFL, DTL, and everything, you need to understand basic concepts of standard costing or costing simply. Now, if you are not aware of the costing as a concept, then I will give you the basic idea, the brief of the costing terminologies, and mainly the terminology which you need for this reading is the contribution. Let's start with the contribution first. So we know the sale minus COGS is equal to gross profit. Sale minus COGS, cost of goods sold, is equal to gross profit. But COGS, cost of goods sold, includes a direct material cost, direct labor cost, some operating overheads, right? So you also incur some overheads relating to the production of goods, which are required for the production of goods. And that's how you get the gross profit. But when it comes to the standard costing, we call this as sale minus variable cost, and the result of sale minus variable cost is contribution. Now, what is this sale and variable cost? So sale simply means sale price. So assume you are running pizza shop, and that in pizza shop you are selling pizza, each pizza or one pizza for $15. Now, to bake this pizza or prepare this pizza, you must be incurring some cost on raw materials, like for example, cheese, bread, some toppings, some vegetables, and everything. And all included, it costs you $5. You have $10 surplus after spending this variable cost with you. This means for every extra unit sold, you are able to generate $10 in extra, and that's the contribution. This also means you can't produce extra unit of pizza without incurring the variable cost. This is the fixed or direct cost which you are incurring to produce or prepare this pizza, right? So you have to focus on this. So sale minus variable cost. Remember, variable cost is direct cost you need to, or the mandatory cost you need to incur in order to produce the extra goods. If you are running, say, mobile factory, then all the material, raw material cost, or all the parts which you need in the smartphone are your variable cost. In example, these are simple example, the pizza shops example, which is relatable and simply related. If you want to produce one extra pizza, then obviously you must be incurring the additional raw material cost, which is again going to equal to the previous cost you incurred for the previous pizza. Very simple, right? Now here, this contribution is very, very useful for us. Why? I will give you some basic illustration for this. So say you and your friend, so this is you and this is your friend. You both started a pizza shop. Sale price, variable cost. Obviously, you both started a pizza shop. So sale price, you are going to keep the same. So $15 and $15 is sale price of pizzas you both are selling. And obviously the variable cost is same, $5 and $5, which gives you contribution. Contribution. And the contribution is $10. Now the thing is, you are able to sell and your friend is able to sell total number of pizzas. So you both sold 10 pizzas in a month. So this gives you $100, $100. Both of you earned $100. But the thing is, you started your shop, you started your pizza shop in a proper rented shop. And your friend started this pizza shop on just street. Okay, so no shop, nothing, and he's just sitting on the street and preparing his pizza on the road. Okay, so no fixed cost is incurred by your friend, but you are incurring fixed cost. And let's say the fixed cost incurred by you is a dollar 200, and obviously by your friend is zero because he's selling on the street. So this means your friend is very happy by selling same number of pizzas you sold, and you are very unhappy at the same level. Okay, so you also sold 10 pizzas, he also sold 10 pizzas, you both had the same contribution, but you are very unhappy because you generated a loss of $100 and your friend generated profit of $100. Okay, and nothing makes a person unhappy, like more unhappy, than seeing your friend doing better than you, right? So this is a joke, but that's fine. Now see here, this particular situation tells us like this contribution is good, but we need to generate or we need to sell enough number of goods so that we are able to cover our fixed cost. Okay, and this particular phenomena is given by, or this particular number of units sold so that you are able to cover your fixed cost, is the break even point. If you generate the break even point, if you sell the goods equal to break even point, then you won't generate any losses. After break even point, if you produce goods more than or sell goods more than break even point, then you will generate profit. Now see here, your fixed cost is $200 and your contribution simply the sale minus variable cost. Remember, the sale minus variable cost is the contribution. This contribution is the surplus you are generating by spending or by selling each extra unit of goods. So here we have 15 minus 5, which gives us the answer of 10. And if you solve this, you have to simply, I'm just calculating this, I know the answer is 20. So 20 number of pizzas. Now, if you sell 20 numbers, the total 20 pizzas, then you will have a break even point. This particular point is known as the break even point. Okay, this gives us a formula for the break even point. So BEP, break even point, and this break even point is also indirectly, like in your mind, you have to think it as total break even point. Always remember. So if you see the BEP, this means the total BEP. I will explain what is the difference between the BEP and OBEP, operating BEP. Now the BEP, break even point, the formula is total fixed cost divided by contribution per unit. Remember, per unit. Here, let's assume the total fixed cost is say dollar 10 lakhs and contribution per unit is say 25. You can take any example. For example, sale price is 50 and variable cost is 25. So 50 minus 25 is equal to 25. So your contribution per unit is 25. And if you solve this, that is a 10,000 divided by 25 will give you 40,000. So this 40,000 is your break even point. At this particular point, you won't generate losses. Below this point, that is, if you produce, say, or if you are able to sell only 35,000 pizzas or 35,000 unit of goods, then you will generate losses. Even a single unit above 40,000 will start generating profits. Okay, will give you the profits. So say if you sell 45,000 units, 45,000 units in total, then you will generate profit. Okay. So this is a very simple concept. Again, for you, I will give you the illustration and just solve this and come in the answer. So say sale price is equal to 60, that is per unit, remember, and it's dollar obviously. Variable cost is equal to say 25 per unit. Total fixed cost is equal to dollar 80,000. And that's it. If you are able to solve this question, you will be able to solve the BEP. That's it. Okay. So there is no further discussion in BEP. That's the end of the BEP. But then we have the operating BEP. So in this BEP, break-even point, we consider the total fixed cost. Now there are two types of fixed cost. One is the operating fixed cost. The operating fixed cost is the fixed cost we need to operate our business. For example, the rent of the factory or rent of the shop. Okay, so this is the operating fixed cost. Then we also have different type of fixed cost, which is financing fixed cost, operating fixed cost, and financing fixed cost. So when you combine both, that is, you consider operating and financing fixed cost, which gives you the total fixed cost. Total fixed cost. If you use total fixed cost in the numerator, this is your BEP, the total BEP. We don't call it as total BEP, but in your mind, you have to think it as the total BEP. But if you only consider this operating fixed cost, then this is the operating BEP. And the meaning is very simple. Again, the same. Operating BEP is the break-even point, the point which is able to cover your operating fixed cost only. Now we will use the same example. $60, 25, 80,000. Sale price 60, variable cost 25, and total fixed cost is equal to 80,000. Now, in this 80,000, say there are two parts. So, operating fixed cost is equal to 50,000 and financing fixed cost, obviously the interest, the very basic meaning of the financing fixed cost is the interest you are paying on the loans. Fixed cost is equal to 30,000. And this is how we get the total fixed cost of 80,000. Now for the calculation of total BEP, that is simply the BEP, break even point, we will use 80,000, that is a fixed cost, total fixed cost, divided by 60 minus 25, and the answer is 2,285 units. Okay, I'll just round it up, 2,286. This is your BEP. Now for the operating BEP, you have to only consider this operating fixed cost, which is 50,000. So 50,000 in numerator, denominator is going to be the same, 60 minus 25. 60 minus 25, which is the contribution. Remember, this is the contribution, this is also the contribution. And the answer is 1,429 units. So at 1,429, so 1,429 units, you will be able to cover your fixed operating cost. And if you are able to sell 2,286 units of your goods, then you will be able to cover all the fixed cost. And after this point, you will be able to generate profits. After this point, it is not necessary that you will be able to generate profits, because it depends. Like if you have fixed cost, the fixed financing cost, then you won't be able to generate profit. You have to sell something extra. But if you don't have any financing cost, so there is zero financing cost, this means the total fixed cost is equal to total operating cost. Sorry, the total fixed cost is equal to operating fixed cost. If this is the case, then you will be able to generate profit. So this is the point you have to remember. BEP and operating BEP. And this is the concept. Very simple. Remember the formulas, understand the concept of contribution, sale minus variable cost, understand the contributions per unit as well as total. What will be the total contribution if you are able to sell, say, 100 units? So total contribution is 60 minus 25. That is a per unit contribution multiplied by total number of goods sold. Whatever is the answer is your total contribution. This 60 minus 25 is the per unit contribution. Okay, don't put total contribution in the denominator while calculating the BEP by mistake. Okay. Now, once you understand this BEP's concept, that is a fixed cost, fixed financing cost, fixed operating cost, and the BEP, break even point. We can discuss the degree of operating leverage, degree of operating leverage, degree of financial leverage, and degree of total leverage. Okay, now see, I'll just show you very simple illustration. Okay, just see this. Now in this illustration, we have situation 1, situation 2, and situation 3. So we are taking 3 situations. In situation 1, we have total number of sale, like units sold is equal to 1000. In situation 2, we have 2500, and then we have the 5000. Sale, total sales, given the price is $15, the total sale in situation 1 will be simply the number of units sold multiplied by the sale price, that is a 1000 multiplied by 15, which is equal to 15,000. Similarly, here we have 37,500 by multiplying 2500 multiplied by 15, and then we have the 75,000, that is 5,000 multiplied by 15. Now here we have the variable cost. Remember, the variable cost is a per unit cost, that is a $5 you are incurring for the each unit. So if you sell 1000 units, so 1000 multiplied by 5 is equal to 5000. Then 2500 multiplied by 5 is equal to 12,500, and then 5000 multiplied by 5 is equal to 25,000. If you do this, you will get the contribution of, in this situation, when you will get the 10,000 contribution, then 25,000 contribution, then 50,000 contribution. If you reduce the fixed operating cost, in situation 1, you are generating, say, loss. So your EBIT, earning before interest and tax, earning before interest and tax here. So EBIT is 1000, then 14,000. In first case, it is a loss. In next case, it is the profit, and then you also have the, in situation 3 also you have profit. Then you have the fixed financing cost, which is 8,000. Your losses will escalate because of this fixed financing cost, because you are already generating losses. So your losses will escalate to 9,000. Here you have fixed financing cost, that is the interest of 8,000. So you will generate net profit of, that is the EBIT, earning before tax. So you don't have to consider tax here. So you will generate the profit of 6,000, and in this situation 3, you will generate profit of 31,000. So this is the basic thing here. Now, degree of operating leverage, DOL, connects the point between the contribution and EBIT. Contribution and EBIT. Remember this. So this is the point A. The contribution is this. This is the ABC. I marked this. So degree of operating leverage. And what is it? I hope you understand the concept of leverage. Leverage is, in physics, we also study the leverage, and leverage means some support. Okay. So what is this support at operating level? And this leverage is based on, this impact of DOL is based on what is the fixed operating cost. So your DOL is simply A divided by B. Okay. So we are connecting this point A, contribution, divided by EBIT. Very simple concept. And in case of the degree of financial leverage, we are connecting the next point, which is B divided by C. And degree of total leverage, DTL, is equal to A divided by C. Just see. Okay, now see. In the degree of operating leverage, we connect these 2 points. So contribution and EBIT. So how EBIT is affected given a specific level of contribution based on or because of fixed operating cost. That's why we take the contribution divided by EBIT. When we discuss the financial leverage, degree of financial leverage, we connect the point of EBIT and EBIT. So now the impacting factor is your interest. So this point B and point C. So EBIT and EBT, mainly the impact will come from this particular part, that is a fixed financing cost. And degree of total leverage connects the point of contribution to EBT. Contribution to EBT. Okay. Now see. DOL is equal to A divided by B. DFL is equal to B divided by C. And DTL is equal to DOL multiplied by DFL. So degree of operating leverage multiplied by degree of financial leverage. This simply means, so A divided by B multiplied by B divided by C. So PB will get cancelled and A divided by C. I will give you the like complete write up here. Okay. So we will discuss everything in the writing. For now, just understand this. Fine. I hope you got this particular illustration, because now we will start putting formulas here. Okay. Just so let's start with the first, so degree of operating leverage. Degree of operating leverage. Now the formula, as we have seen in the illustration, is the contribution divided by EBIT, earning before interest and tax. Right. EBIT simply means, so it is contribution minus fixed cost. Let's see this. Contribution minus fixed cost will give you the EBIT. So I will use the same formula. So you have contribution divided by contribution. I'm simply writing the contra here. Contribution minus fixed cost. Okay. Here, this contribution is total contribution, not per unit contribution. This is total contribution. Always remember this. Okay. So total contribution divided by total contribution minus fixed cost. Now, how to calculate total contribution? We already understand the formula of contribution is sale minus variable cost multiplied by total number of units sold. Quantity divided by S minus VC into Q minus fixed cost. And that's how this formula shows up. I decided to, like, I started with contribution and EBIT and then I developed this formula, because if you directly see this formula feels quite intimidating. So that's why I decided to go by this route. If we take or consider our example, so 15 minus 5, 15 minus 5, the 5 is a variable cost here. And I'll just write it down here only. So 15 minus 5 and total number of units sold 1000. Let's take the example of 5000. It is better. And then divided by 15 minus 5 multiplied by this quantity again, same 5000 minus fixed cost. What was fixed cost here? Fixed cost is fixed operating cost, sorry. So fixed operating cost is 11,000. 11,000. And simply solve this. 15 minus 5, 10 multiplied by 5,000 is equal to 50,000. 50,000 is your contribution here, divided by EBIT is 39,000. 39,000. Answer is 50,000 divided by 39,000. 1.28. 1.28 is the degree of operating leverage at, remember, at sale level. Your degree of operating leverage will change based on, if you are calculating DOL at a specific level, so it will change if you change the level of sales. So degree of operating leverage, so DOL will be different for 25,000 units or say 2,500 number of units sold. It will be different from 5,000 units sold, and it will be different for 1,000 units sold. So it is DOL will be based on total number of units sold. Now here, if you make this fixed cost 0, say there is no fixed cost at all, it's fixed operating cost. I'm saying fixed cost, but again, this is a fixed operating cost. So if there is no fixed operating cost, in this case, the answer is 1. Okay, so degree of operating leverage is equal to 1. Now, if you increase fixed cost substantially means this goes beyond 50,000. Let's for now assume your fixed cost is 55,000, then your denominator will be negative and your degree of operating leverage will be negative. Okay, so you can get degree of operating leverage negative, but there is a condition that fixed cost should be more than the contribution. So you must be generating losses already. And that's how you get the negative degree of operating leverage. Okay, but in general circumstances, like in the normal circumstances, if your firm is able to generate profits, so lowest your degree of operating leverage can go is the 1. Okay, that's the lowest value. And if you keep increasing the fixed cost, your degree of operating leverage will increase. So higher degree of operating leverage means higher fixed cost. This is a statement to remember. Higher degree of operating leverage means higher, again I'm saying fixed cost, but this is the operating fixed cost, please remember. Higher degree of higher DOL means higher fixed cost. Okay, so in exam, you may get question like a company A has a higher DOL than the company B. This means the company A has the lower fixed cost than the company B. Is this statement correct or not? This is a correct, incorrect statement. Okay, so the correct statement is if the company A's DOL is higher than the company B's DOL, so assuming all the other circumstances are the same, then the your fixed cost for the company A is likely to be higher than the company B, assuming, as I said, all the other factors are constant. Okay, fine. So higher DOL means higher fixed cost. Next is the degree of financial leverage. There is one more formula for degree of operating leverage and degree of financial leverage, which I will explain you after I finish or finalize this whole discussion. Degree of financial leverage. Now, degree of financial leverage, as we know, this is EBIT divided by EBT, earning before interest and tax. We already saw the EBIT's formula. What is the EBIT's formula in our case? This is contribution minus fixed cost. And what is the contributions formula? So quantity of units sold, total number of units sold, multiplied by sale minus variable cost minus fixed cost, FC, right? And what is your EBT? Okay, just a second. This is operating. And what is your EBT? Same formula. Sale minus variable cost minus fixed operating cost. I will write it as FOC. FOC, fixed operating cost, minus fixed financing cost. I am writing it in short because how you write the formula is not important for your exam. How you understand the formula is very important. Okay, so simple. Q, sale minus variable cost minus fixed operating cost divided by Q into sale minus variable cost minus FOC minus FFC. This FFC, fixed financing cost, is simply interest. So I'll just write it as interest. And I'll write this as operating fixed cost, OFC. Okay, it is better. OFC sounds better. Operating fixed cost minus interest. So this is how you get the formula for the degree of financial leverage. Degree of financial leverage. Now again, you can take the example which we took. So we already know we are taking again for the 50,000. 50,000 as in the 5,000 number of units sold. So in 5,000's case, our contribution was 50,000 minus operating fixed cost is 11,000. Again, we are using the same previous illustration. This now denominator is in the numerator divided by 50,000 minus 11,000 minus interest cost is 8,000. And if you solve this, you will get this. The numerator is 39,000 divided by 39,000 minus 8,000 is equal to 31,000. So 39,000 divided by 31,000 is the degree of financial leverage. So this is 1.25. Okay, degree of financial leverage is 1.258. Okay. I hope you got the point. Okay, so degree of operating leverage divided by and degree of financial leverage. Now, what is degree of total leverage? So, degree of total leverage is equal to simply degree of operating leverage multiplied by degree of financial leverage. You have to multiply both. DOL multiplied by DFL is equal to DTL, degree of total leverage. In total leverage, we will consider complete fixed cost, total fixed cost. So, fixed operating cost and fixed financing cost. That is the operating cost plus interest. Simple. We already understand the formula. The formula for the degree of operating leverage is contribution divided by EBIT and financial leverage is EBIT divided by EBT. So, contribution divided by EBIT multiplied by EBIT divided by EBT, and simply EBIT cancelled. So contribution divided by EBT, earning before taxes. That's it. And now simply put the values. You already understand this. Q into sale minus variable cost is your contribution in the numerator, and in the denominator you have Q into sale minus variable cost, total contribution, minus your OFC, operating fixed cost, minus interest. Right? So this is your formula for degree of total leverage. So numerator we already understand, this is the 50,000 divided by, it is 31,000. And simply solve this. 50,000 divided by 31,000 is 1.612. Okay. And we already know these values, 1.258 and 1.28. So 1.258 multiplied by 1.28. So if you multiply this value and this value, you will get this value. So in exam, you are just provided with say contribution, financing cost, and operational fixed cost. You will be able to handle this question easily. So DTL, DOL, and DFL, both the concepts are very, very easy. Now here we have alternate formula for degree of operating leverage. Remember, so these formulas were at a specific level, okay, level of sale. So as I said, it will be different for 1,000, 2,500 and 5,000. Obviously, it will be different. But we also have one generic formula, which is degree of operating leverage is equal to percentage change in EBIT, percentage change in EBIT divided by percentage change in sale. So whatever is the quantity of sale given, what is that like? This simply means the change in sale will impact the change in EBIT. And the formula is change in EBIT divided by EBIT. So this is kind of elasticity formula in the economics. And then change in sale divided by sale. So percentage change in sale and percentage change in EBIT will give you the degree of operating leverage. So if your DOL, again, so generally if you get the question, so percentage change in EBIT and percentage change in sales will be directly provided to you. So the implication of this formula is to understand how this, like the percentage change in sale will impact the percentage change in EBIT. That's the important point here. Now we can put values here. Okay, so values like say change in EBIT. Let's take the values like, so sale from level 1 to level 2. So 10,000 to 12,000, and your EBIT is equal to say 1 lakh to 1,50,000. Okay, so this is very simple. What is your change here? Delta 2,000, and here delta is, that is change 50,000. So simply solve this. So percentage change in sale divided by percentage change in EBIT. Sorry, percentage change in EBIT divided by percentage change in sales. So you will get the formula equal to, so 50,000 divided by, what is the initial level of sale? So this is, sorry, initial level of EBIT 1 lakh divided by 2,000 divided by 10,000. Simply solve this and you will get your answer. Now you can do the calculation. So for me, this particular part, the calculation is not that important because the formula is very simple and straightforward. Here, the point I'm trying to make is this. If your degree of operating leverage, say, is 1.75, just a hypothetical situation. Now, the percentage change in sales will impact the percentage change in EBIT, but what will be the total impact is given by simply this percentage change in sales, you multiply it with the degree of operating leverage. So percentage change, I am just restructuring this formula. So percentage change, I'll simply write it as percentage change in sale is equal to percentage change in EBIT. Okay. So I simply restructured the formula. So DOL is equal to percentage change in EBIT divided by percentage change in sales. I simply took the percentage change in sales and got it on the left hand side. So DOL multiplied by percentage in sale is equal to percentage change in EBIT. So if the sale increases, now that's the important thing. If the sale increases by 5%, if I provide you the information, or in exam, say you are provided with the information, if the percentage change in sale increase, or the percentage change in sale is 5%, simply the sale increased by 5%. What will be the percentage change increase, obviously, in EBIT? So it is 1.75 multiplied by 5%, and whatever is the answer, 5 multiplied 1.75, this will be the total 8.75% change or percentage change in EBIT. Very simple. Okay. Now, if at the given level your EBIT is, say, what is the EBIT? 1 lakh. Yeah, 1 lakh. Okay. So if your EBIT in the at the given point is 1 lakh, so given the 5% increase in sales, your EBIT will change by 8.75%. So 1 lakh plus 8.75% is equal to 1 lakh 8,750. Simple. Okay, this is the implication here. So you need to understand this. Similarly, we have formula for degree of financial leverage. Degree of financial leverage, and the degree of financial leverage formula is percentage change in EPS, earning per share, divided by percentage change in EBIT. Again, so EBIT to EPS is mainly the interest and taxes. So here percentage change in EPS divided by percentage change in EBIT. Again, the ultimate use of this formula is if your degree of financial leverage is 1.30, then for given change or for the percentage change in EBIT multiplied by DFL will be the percentage change in EPS. Earning per share will change by this percent. So again, if I provide you the information, if the percentage change in EBIT is 5%, that is a 5% increase in EBIT, if this is the case, so then what will be your percentage change in EPS? So simply 5% multiplied by 1.30, 1.30 multiplied by 5. So your EPS will increase by 6.5%. So whatever is the EPS, so just add 6.5% in that level. Simple, very simple. Okay. So this is the degree of operating leverage, degree of financial leverage, and as we did before, so degree of total leverage is equal to, so percentage change in, just a second, percentage change in EBIT divided by percentage change in sales multiplied by, this is your degree of operating leverage, percentage change in EPS divided by percentage change in EBIT. This is your degree of financial leverage. And we know the DDL is equal to DOL multiplied by DFL, degree of operating leverage and degree of financial leverage. So simply multiply it, this will get cancelled. And finally, you will get the formula percentage change in EPS divided by percentage change in sale. Now again, the same question. If the sale increases by 5%, the change in sale in percentage is 5%. Remember, this is the percentage. So if the sale percentage change in sales is 5%, then what is the percentage change in EPS given the degree of total leverage is, say, 2.2. Degree of total leverage is 2.2. Percentage change in sales is 5%. So what will be the percentage change in EPS? So 5 multiplied by 2.2. is equal to 11%. 11% is equal to your degree of total leverage. Very simple. And these are the points you need to remember. Now here we have one specific discussion, which is the impact of degree of financial leverage on the return on equity. And we will take, or we will directly use the illustration given in the book itself. Okay, so this is the illustration. And illustration is very simple to understand. This is from the CFA Institute's curriculum. And we have situation number 1 and situation number 2. So these are the two situations here. In situation number 1, we are starting with the no debt. So 100% the company is financed by equity and total equity is $2 million. Now, the expected earnings are given here. Okay, so at 40% plus 40% and the earnings here. So simply this is the EBIT. Okay, so 3 lakh EBIT, 5 lakh and 7 lakh. And here we are talking about the impact of financial leverage. We are not talking about the operating leverage or the total leverage. And that's why we are starting with the EBIT. Let's say, for example, if we want to consider the impact of operating leverage, then we should start with the contribution. But here we are starting with the EBIT, means the contribution and the fixed operating cost part is over. We are at EBIT level. So only factor which we need to consider here is the interest cost. Now see, EBIT 3 lakh, 5 lakh, 7 lakh, 5,000. There is no interest expense because the company is 100% financed by the equity. So no debt situation here. So interest expense is 0. Then we have the taxes at, say, whatever is the level, 40%, 30%, whatever it is. So EBIT, earning before taxes and EBIT is equal here. So same values. Then we have the taxes, whatever is the percentage. I'll just calculate the percentage. 90,000, 9 divided by 30. 30% taxes. So 90,000, 1 lakh 50,000 and 2 lakh 10,000. And the answer net income is 2 lakh 10,000, 3 lakh 50,000 and 4 lakh 90,000. Your capital investment is 2 million. Your net income is 2 lakh 10,000. So 2 lakh 10,000 divided by capital investment 2 million. Answer is return on equity. And return on equity in this particular case is 10%. If you consider the situation 2 here, simply the expected earning. So 3 lakh 50,000 divided by 2 million, answer is 17.5% and 24.5%. Okay, this is a situation when you have no debt. Now in the next example, we will consider the same EBIT, but we will use a 50% financing, 50% debt. And this will generate the interest expense at this particular layer. Just consider like what should be the situation? Like if we add debt into the equation, should our return on equity reduce or increase? So the degree of financial leverage or degree of operating leverage, mainly the financial leverage, we say or we know based on or using this example, more leverage you use, better the return on equity. This is the principle. Okay, now see here. We are adding 50% debt and what is the percentage? So it is at 10%. Now see here, shareholders equity is 1 million now. Now again, EBIT is exactly same as before. So there is no change, but 50,000 is interest expense, which is same in all the cases. Now here we have EBT, earning before taxes. So 2 lakh 50,000, 4 lakh 50,000 and 6 lakh 50,000. Then we have the taxes on it and then we have the net income. Now remember, return on equity, ROE, is net income divided by capital invested, and here your capital invested is 1 million. So mainly our denominator is changing. So denominator is directly half. So if you solve this 1,75,000 divided by 1 million, so you get return on equity equal to 17.5%. In this case, you get 13.5%, and in this case, you get 45.5%. Compared to this, like the previous situation when your company is 100% financed by the 100% financed by the shareholders. In this case, our ROE is at the lower level. Remember this, ROE is at the lower level, and also the variability, that is 10%, 17.5%, 24.5% is also low. Variability or the deviation, the standard deviation is also low, and the levels of return on equity are also low. When you introduce debt into this equation, because of the degree of financial leverage or financial leverage, your return on equity will increase. So simply, as I said in the beginning, the leverage, the word is used for the support. We all understand the concept of pulley, right? So if there is some heavyweight object, the stone, right? and we try to simply lift it by our hands, it is very difficult. So we apply leverage. Search for the leverage on Google, you will get the image there. So we apply leverage, maybe pulley and something like that. And when you apply leverage, you get the better results. And this debt is your leverage. So that's why degree of financial leverage will help you in increasing return on equity levels as well as the deviation, but at the cost of risk of bankruptcy. If the company is 100% financed by the equity, and if like even if your EBIT is zero, you're not going to get bankrupt. But if your EBIT is zero, in this case, when you have debt, then the company will go bankrupt. So remember, the profitability is increased, so level of return on equity is increased, variability, the deviation of return on equity is also increased, but at the cost of risk of bankruptcy. Okay, so this is the takeaway from this particular illustration. Okay, and one more thing, so this is the ultimate like outcome of this topic. So complete discussion, you will be able to solve questions based on this illustration or based on this discussion, whole discussion. We have few basic questions. Okay, now the basic questions are the basic discussions. Main the business risk. Okay, then we have the sales risk and the operating risk. Now these are basic concepts. Just read it out and you will understand. Nothing is difficult in this particular part. So I mainly discuss the core part here. Okay. Now to give you the brief. So here we have the business risk. As I said, the business risk, operating risk, and the sales risk. Now the sales risk is the uncertainty in sales level. Operating risk is uncertainty in your operating income. Okay. And your business risk is combining both. Simple, in simple terms. Okay. So it is simple, very simple. Combining both gives you the business risk. Fine. So that's a discussion, the complete discussion. If you have any doubts, feel free to comment or feel free to ask me. That's the end of the discussion. Thank you and thank you for watching this video. See you in the next video. Bye bye. Take care.